Have you ever seen those moments in the market and wondered how the pros pull huge profits out of what seems like a tiny change? Well, today, we're pulling back the curtain on one of their biggest secrets, the incredible power of what we call time leverage in the bond market.
So, picture this. The news flashes. The Federal Reserve is cutting interest rates by just 1%. For most people, that's just a headline you hear on the news and, you forget about it 2 minutes later. But for bond investors, that single announcement is like a starting gun.
And what happens next is pretty amazing. Because of that exact same piece of news, investor A makes a solid 4% profit. Hey, not bad at all. But investor B, in the very same market, makes a staggering 12% profit. That's 3 times more. So how on earth is that possible?
This has nothing to do with luck. It's not about being a better market timer or having some kind of secret inside scoop. It's all about understanding a fundamental principle of how bonds work, a principle called time leverage, and we're about to break down exactly what that means.
To really see this in action, we're going to run a super simple experiment. Let's just take 2 different bonds and watch how they react to the exact same event.
Okay, so here's our setup. And what's really important to see here is just how similar these 2 bonds are. We've got bond A and bond B. Both are trading at par, which just means their price is their face value. They both pay a 5% coupon every year, and the market yield is also 5%. The only real difference between them is time. Bond A is a short-term bond that matures in 5 years, while bond B is a long-term bond with 20 years to go. So on paper, they look like twins, right? But as you're about to see, that one single difference, their lifespan, completely transforms them. It turns them into 2 totally different financial machines, each with its own unique kind of power.
So, we've got our 2 bonds all set up. Now let's introduce that one tiny but really dramatic change that we talked about at the beginning of our explainer.
The market interest rate drops by 1%. It goes from 5% down to 4%. Now, in the grand scheme of things, that's a pretty small shift. So this is the million-dollar question. With this rate drop, what do you think is going to happen to the price of our short-term bond versus our long-term bond?
And boom, this chart just perfectly shows the power of time leverage. The 5-year bond, it sees a nice capital gain of about 4%. That's a really respectable return. But then you look at the 20-year bond. Its price absolutely skyrockets by 12%. It's the same rate drop, the same market, the same coupon, but you get 3 times the profit.
So the key takeaway is this: the longer a bond's maturity is, the more sensitive its price is to any changes in interest rates. A long-term bond reacts in a huge way to every little sneeze from a central bank, while a short-term bond is just a lot more stable. Now, this effect isn't magic. It's pure math, and you better believe professional traders have a very specific tool they use to measure this sensitivity. It's actually what lets them predict these price swings with incredible accuracy. But why does this happen? Well, it's actually pretty simple when you think about it. When you buy that 20-year bond, you are locking in that sweet 5% payment for 2 whole decades. So when new bonds are suddenly only paying 4%, your old bond with its higher payout becomes way more attractive, right? All that increased future value gets priced into the bond today, and that's what causes its market price to jump up.
This measurement, this gauge of a bond's price sensitivity, is called duration. It's basically a number that tells you, in percentage terms, exactly how much a bond's price is expected to move for every 1% change in interest rates. And for those of you who are interested, in Hebrew this concept is called macham, which is an acronym for average lifespan. It's just a great example of how this is a core concept in bond markets all over the world.
And you have to understand, this is not just some abstract academic idea. For professional bond traders, duration is their compass. It is the #1 tool they use to navigate interest rate changes, to manage their risk, and to hunt for profit.
Okay, so understanding the concept is that first super important step. But the real power comes from knowing how to actually apply it. So the question is, how do you take this idea of duration and turn it into a practical tool that you can use for your own investments?
Well, that's exactly what we're going to cover next. In our follow-up explainer, I'm going to break down the actual calculation for duration, step by step. I'll show you how to transform this concept from just a theory into a powerful working tool in your own financial toolkit.
So there you have it. That's the power of time leverage. I really hope this helps you look at bond markets in a completely new way. Good luck with your investments, and I'll see you in the next explainer, where we're going to dig into the math.